As we approach the end of the tax year, there are a number of tax-efficient investing options that we are encouraging clients to consider. So joining me today to talk about this in a bit more detail is Shan Robson, our Head of Wealth Planning, and Will Stevens, our Head of Financial Planning. Will, have you got any ideas about what clients could be thinking about as we approach the end of the tax year?
Thank you, Rachel. As you mentioned, we're heading towards the end of another tax year. And as we get towards the end of this tax year, we're encouraging all our clients to make use of the allowances they've got available to them, particularly any use it or lose it allowances that are available. Over the last few years, we've seen a bit increasing pressure on the taxable allowances that are out there. In particular, the focus on if you've got investments held in a taxable environment, in what we would refer to as a main account, the allowances on those have really been pushed down over the years and will be coming down again next year.
Yeah, there has been so much change over the last couple of years. There's been a lot of volatility. We've got a general election coming up later this year, and I think that probably means more change. So I think you're absolutely right to say that clients should be making the most of whatever they have available to them now.
Absolutely. And as we look to move into the next tax year, we'll start with capital gains tax. That's going to be coming down. As you mentioned, that may be coming down further again in the future. We had a capital gains tax allowance that, if you look back, last year was north of £12,000, came down to £6,000 this year, we're decreasing down to £3,000 next year. Now, similarly, there's a dividend tax allowance. So from the income produced from your investments, that used to be at £2,000, it's come down to £1,000. And then again, on the 6th of April, it's going to drop to £500. So it's really important that if you do hold investments within a taxable wrapper, that you start to look at getting them into something more tax efficient and really look at getting those wrapped up so that the long-term tax drag on your investments isn't too significant. Now, when we talk about tax wrappers, a key one that we talk about here at Killick, but widely within the industry, is that of an ISA. Now, ISA allowances for each individual currently at £20,000 per person per year. So that means you can put £20,000 of savings or investments into the wrapper, and then that will grow free of any further income tax or capital gains tax whilst it's inside the wrapper. So it's quite a powerful investment vehicle, particularly if you're talking about a family where you might have a £20,000 allowance each between the husband and wife. And if you've got children, there's junior ISAs as well. And the junior ISA allowance is currently at £9,000. So you can put quite a lot of money into those wrappers and let that grow free of any further taxation. Now, when we look at the allowances for that, we've got £20,000 and £9,000. Those are at historically quite high levels. If we look back over previous years, they were at much lower levels. So we want to make sure that clients are using those whilst they're at this level. In particular, these are, as I mentioned earlier, use it or lose it allowances. So they don't roll over into next year. If you don't use it before the 5th of April, it will be gone. So that's ISAs. But I think a key one that we should probably talk about today is pensions. So Shaun, why don't you talk us through pensions?
Yeah, I think you will. So pensions offer probably the most tax efficient allowances available. Pension contributions being subject to what we call the annual allowance. The annual allowance is the maximum amount that you can save into a pension tax efficiently. And actually, over the course of this tax year, has increased quite generously from £40,000 up to £60,000. And the benefit of the pension contribution is the tax relief that you get on making the pension contribution. So for a basic rate taxpayer, if they make a pension contribution, they're able to claim 20% tax relief. So in the scenario of contributing £60,000, the potential of maybe claiming up to £12,000 tax relief. For higher rate taxpayers, the benefit then increases by another £12,000 up to £24,000. And the net contribution in that situation would only need to be £36,000 to then have the benefit of £60,000 of inside your pension wrapper. Quite similar to the ISA, the pension can grow completely tax-free whilst it's invested. So there'll be no income tax and capital gains tax on the underlying investments as they continue to grow. So a great way of saving some of your investments for retirement and planning for the future. I've talked about the annual allowance being sort of £60,000. It's also worth considering perhaps the wider family as well when it comes to pension contributions. But a little unknown rule is around pension contributions for younger members of the family. So you can make use of the junior SIP and contribute up to £3,600 per year for somebody who perhaps is under 18, doesn't have any earnings, but they can still benefit from tax relief. So a contribution of £3,600 would only require a net contribution of £2,880, which would benefit from tax relief of £720 per individual. So you're looking at a family of four. If there's a married couple potentially earning up to £60,000 each year, able to maximise their pension contributions for both themselves and for their children as well. Now, considering a lot of the allowances we've been discussing today are use it or lose it for the end of the tax year, the pension regime is slightly different and a little bit more flexible. So the pension regime allows you to look back over the last 3 tax years for any unused allowances that you may have and carry them forward to the current tax year. So potentially for someone who has been a member of a pension for the last few years but hasn't really been paying attention to how much they could contribute and is now looking to carry forward all of their unused allowances into the current tax year and maximise this year's allowance, they could look at making a contribution of up to £180,000, so quite a sizable amount that you could potentially get into a pension tax efficiently.
One point to add is that clients could use investments from their main account to contribute to either the ISA or the pension. So for example, if they have an investment in the main account that's currently sitting on a profit, they could sell that investment, buy it back in the ISA or the pension, and then they've used their capital gains allowance and they've still got that investment.
Yeah, absolutely. And a really good point around the flexibility of the pension wrapper itself. Now at Killick, we use what we call a self-invested personal pension. The reason for doing so is because it offers the most investment flexibility from all of the different types of pensions that exist. So we really believe it's a great way of saving for your sort of retirement income into the future and being able to give you the most flexibility in terms of the way that you can invest those underlying investments.
And here at Killick, we love buying individual shares, we like buying direct bonds, and the flexibility of the SIP does allow us to do that. So we talked about ISAs, we talked about pensions. Are there any other tax-efficient wrappers or tax-efficient investments that we could be thinking about?
Very good question. So beyond sort of the mainstream types of tax wrappers we've discussed, ISAs and pensions, for those individuals that perhaps have high incomes and they've gone and utilised all of their allowances and their exemptions, perhaps them and their family, and still have a large income tax bill to contend with, there is the potential to look at alternative tax incentivised investments, namely venture capital trusts and enterprise investment schemes. Now, both of these investments are higher risk in nature, and the reason for that is because they invest into either early stage or startup type companies or small companies, and therefore the government are trying to promote investment into this sort of early stage in the British economy, and for that you're able to claim tax relief at a rate of 30% on the investment. So as an example, if somebody was looking to make a £100,000 investment into a venture capital trust, there's a potential for them to claim £30,000 tax relief on that contribution, and therefore the net contribution into that investment is only £70,000. Now I would caveat, of course, given the high risk nature of these types of investments, I would encourage people to consider taking advice before doing so. When we're looking at advising clients on these types of investments at Killick, it's always taken into consideration amongst their entire portfolio to make sure they've got a balanced approach to how they invest the entire portfolio and not concentrating too much on these higher risk type investments.
So you talked briefly about income tax there. Are there any other points about income in general that you think you could add?
Yeah, maybe just some notes really around income tax planning. Now, when you come to the end of the tax year, it's always worth considering, do you have flexibility, control over the income that you'll be generating over the course of the year? And really, individuals who may be in that position are people that perhaps self-employed, who own their own companies and are able to perhaps control how much they withdraw from the company into their personal names. So actually, it's worth giving some consideration at this point, before you get to the end of the tax year, about any sort of income tax sort of pitfalls and traps that exist. And namely, one of those is around the loss of the personal allowance, where your income exceeds £100,000 in a tax year. So for any individual that has or is close to earning £100,000 worth of income, it's worth just taking a note and seeing if there's anything you can do to try and mitigate the loss of the personal allowance. Now, the loss of personal allowance works very simply where every £2 of income that you earn over £100,000, you start to lose £1 of your personal allowance to a point where you have no personal allowance remaining at just above £125,000. The effective tax rate for that element of income between 100 and 125,000 just over is effectively 60%, which is obviously a huge rate of tax compared to other rates of tax at 20, 40 and 45%. So there are planning opportunities around the loss of the personal allowance, namely making pension contributions. And again, I would say anybody in that situation who thinks, oh, actually that really resonates with me, I would encourage them to take some advice on potentially how they might be able to mitigate that before the end of the tax year.
And just to finish on Will, are there any other final points that might be helpful for people to think about?
I think one thing that individuals may not have been thinking about, that they may need to think about moving forward, is interest savings. Now, historically, we've been in a zero interest rate environment where we've been getting little to no interest on cash we've held at the bank. Now, it's very important for clients to retain cash at the bank. We always talk to clients about having rainy day savings. potentially holding pots of cash for upcoming calls on capital. If you want to buy a new car, you've got to do some refurbishments on the house, for example. So holding cash is really important. But as interest rates have climbed over the last 18 months, the interest attributed to that has gone with it. Now, there is an allowance for how much interest you can actually accrue within a bank account before you start to pay tax, but it is quite low, and it's dependent on your level of your rate of tax as a taxpayer, so whether you're a basic rate taxpayer or a higher rate taxpayer. For those who are additional rate taxpayers, they have no allowance at all. So as this has climbed, individuals may want to be looking at different alternatives for holding cash or cash equivalent to make sure that the return on that is as tax efficient as possible. We've talked about in previous videos our Gilt Saver service, which we recently launched. That Gilt Saver service is designed to invest that money more tax efficiently by putting it into government debt rather than holding it as cash at the bank.
Well, thank you, Will. Thank you, Shaun. So those are a few of the areas we are encouraging clients to think about ahead of the end of the tax year. If you would like to talk about those in more detail, or if you would like to speak to our planning team about structuring your finances in a more tax efficient way, please do speak with your advisor.